In this morning's U.S. Bank Economic 360, the U.S. consumer and business environment has experienced very low interest rates over the past 5 years. While there are early signs of a reverse in this trend, rates currently remain very low, both locally and globally. For perspective, we turn to our very own Jim Russell, U.S. Bank Wealth Management Senior Equity Strategist, who just celebrated a birthday. Happy birthday, Jim. He's with Business Courier editor Rob Dahlmeyer in the studio. Jim and Rob.
Thank you very much. Happy birthday, man.
Thank you, sir. I think you have one pending, do you not?
I do, next week.
Okay.
It's not a big one.
Another year wiser,
it's just
right?
50, that's right.
Yeah.
So where specifically are interest rates right now? And frankly, also, how does that compare against other countries?
Yeah, interest rates in the United States have been very low, Rob, for some time. You know, ever since the Great Recession, the Fed has taken an active role keeping short-term interest rates very low. They've also taken on the unique quantitative easing program, has kept longer-term interest rates low. Inflation has been low. Frankly, growth in the United States has been very sloppy and continues to be a little bit bumpy. Interest rates really over the last several months have actually taken a dive and gone down quite dramatically. And frankly, in other countries as well, we have seen other countries, especially Germany, especially Europe, see very low interest rates. You can see that in the United States is shown in blue here. As low as interest rates are in Germany, they're much lower. To give you a point comparison, right. In the United States, 10-year bond rates are approximately 2.4% today in the United States and below 1% in Germany. So that really tells you that inflation is quite low. Growth is quite low in Europe, as well as we do think that the military action between Russia and Ukraine is also has some influence there as well.
So when rates are persistently low,
right.
We're talking, you know, nobody's really afraid of a giant spike.
Right. How
does that have, what impact does that have?
It really influences all kinds of behaviors, both on the consumer side and the business side. Usually interest rates, when they're on the low side, really kind of indicate that growth is slow, it's likely to remain slow, as well as inflation. And there's also a risk aversion element, as mentioned in Europe as well. It also has a very strong impact on currencies. Right. And what you can see here is the relationship between the euro, which is the primary currency in Europe, and the U.S. dollar. And you can see that the euro has gone down dramatically against the U.S. dollar just last week. Europe lowered interest rates yet again to spur the economy along, and they're taking on a United States-like or Federal Reserve-like quantitative easing program as well. A lower euro currency is likely to spur export activity and perhaps goose the economy just a little bit. At least that's the hope.
But America fights against that as well. I mean, they like a high euro. So
that's correct.
Anyway, so since it's your birthday, put on your Mr. Wizard's hat for us just to have fun. Where are rates going to go over the next couple months?
That is the 800-pound gorilla question for the capital markets, frankly for the business community, really over the next 18 months. We've had a very open field to run in terms of interest rates over the last 5 years, as you'd mentioned. And so we really think that probably a transition's afoot here. Federal Reserve likely to increase interest rates either in the first or second quarter of 2015, and some language probably setting the stage for that, probably coming around September, October or so. And so there's going to be a lot of jostling around in the capital markets as we're probably transitioning to a higher interest rate environment in the months ahead.
Gotcha. Jim, thanks for being here. Happy birthday. Hope you have a good time.
Thank you, Rob.